Well, good evening, ladies and gentlemen. How we doing? Spectre here for another edition of Midnight Rider. Good to have you aboard. Tonight on the broadcast, we are going to cover some financial-related stuff here this evening, some of the things I'm seeing play out here. First of which, we're going to talk a little bit about the money supply, as well as the velocity of money, by way of an article here, the things that have been playing out. And, of course, we're going to talk a little bit about inflation, and, of course, as the title alludes to, the biblical rise of food prices, and it's going to be a little bit of a read on that one. So that's what we're going to cover here tonight. Appreciate you joining. We'll see you back here momentarily on the other side. Warning. These social media platforms may be hazardous to your health. Censorship kills. Pain coming. This has been a PSA by Breaking Spectre. Alright, welcome back everybody. Like I said, tonight on the broadcast, a little bit different spin. We're going to talk a little bit about some financials, some of the things that are going on by way of the economy tonight. So without further ado, let's just get into it here this evening. First article tonight is out of Charles Hugh Smith's of2minds.com blog, talking about our dead money economy. And before I get into that, I guess it's important to note a couple things that have happened here in the last couple days. For those who know, the Fed and the FOMC met here in the last 48 hours. And we're going to start to see interest rates go to the negative side, which means ultimately at the end of the day, you are going to be the ones paying the banksters to house your assets, your money. And of course, that's not a good thing. So it begs the question at the end of the day, why do we even still need banks at this point? So we're going to get into that. And of course, if you've paid attention to the Fed, you know that over the last year, since the advent of COVID, they've been basically piping in about $160 billion a month into the money supply. $160 billion a month, just some chump change in that to throw around. So we're going to get into that. It says our dead money economy, the U.S. stock and bond markets, and its entire financial system now teeter on the edge of collapse if there is even a slight hint that 1. The Fed won't give more free candy to Wall Street, or 2. The Fed has lost control of the dead money economy it has created. So taking a quick glance at these depictions of dead money, while the broad measure of the money supply in the U.S., known as M2, has gone up 12-fold, since the start of 1981, the velocity of money, how many times it changes hands over a period of time, has collapsed. What does this tell us about the U.S. economy and what lies ahead? The Federal Reserve's FRED database provides a definition of M2, and that's a good starting place. Note that the Fed refers to money stock, where the word stock refers to the sum total of money in the system, as in the store is fully stocked with merchandise. They're not referring to the stock market, but to all the money that's in the store of our financial system. Cash, money in checking accounts and money market funds, etc. Here's the definition of M2. It says beginning May 2020, M2 consists of M1 plus 1 small denomination times deposits, time deposits in amounts of less than 100,000, less IRA and kiosk balances or depository institutions, and 2, balances in retail, MMFs, basically money market funds, less IRA and kiosk balances at MMFs. Put somewhat more directly, M2 is all the money in the financial system which people can spend. It doesn't include the money in individual retirement accounts because that has been set aside for the long term and is not available except in cases of early withdrawal to spend. So here's the definition of the velocity of money. The velocity of money is the frequency at which one unit of currency is used to purchase domestically produced goods and services within a given time period. In other words, it is the number of times $1 is spent to buy goods and services per unit of time. If the velocity of money is increasing, then more transactions are occurring between individuals in an economy. A decreasing velocity might indicate fewer consumption transactions are taking place. Now, you might have seen one of the illustrative tales circulating around the web about the one $10 bill that ends up paying a half dozen debts as it circulates through the town. The grocer pays a debt owed the baker, who uses the $10 to pay a debt to the florist, and so on. This is an example of a high velocity of money. The $10 bill changes hands many times in the space of a few hours, funding transactions that all lead back to the exchange of a good or service. There's one part of the definition that is often overlooked. The velocity of money only tracks domestically produced goods and services. So all the transactions that end up in a container of goods from China being unloaded in Long Beach aren't counted. And I've annotated the charts of M2 money stock and the velocity of M2 money to provide historical context for the unprecedented expansion of the stock of money and the equally unprecedented collapse of money velocity. In short, while America's GDP, aka Gross Domestic Product, has gone up 6.5-fold since the start of the financialization, globalization boom in 1981, the stock of money has risen 12-fold. This is striking. Money stock basically doubled from 2009, the brief global financial crisis recession, to last February, before the pandemic had any impact on the economy. In other words, setting aside the extraordinary vertical expansion of money stock in the past year, the U.S. economy's stock of money doubled in a bit of over a decade, just to keep GDP, aka growth, at an anemic, barely above flatline rate of expansion. Put another way, there wasn't much bang for doubling the supply of bucks. Meanwhile, the velocity of money has absolutely tanked. In the era of widespread prosperity in the 1960s and 1970s, the velocity of money ratio remained in a band between 1.7 and 1.8, moving up toward 2 in the inflationary late 70s, as it made sense to trade cash that was losing value for goods and services before it lost even more purchasing power. Velocity returned to this range in the 1980s boom and then rocketed to post-war highs at 2.2 in the internet boom of the 1990s. Since that top in 1997, money velocity has been in a secular decline. As every Fed-inflated financial bubble pops, money velocity takes another leg down. Even before the pandemic, it was in a steady free fall, even as the supply of money steadily rocketed higher. And here we see the Fred chart indicating the M2 money stock. Again, this going back to pre-1960 all the way to and through about where we are today, February 2021, where we're sitting at about 19.4 T with a trillion, and our GDP is right around 21 trillion. Highlighting the fact that GDP is up about 6.56x, the money stock is up about 12.12x since 1981, as the article alludes. And then the velocity of M2 money stock, again highlighting the very same time period here, kind of shows it bouncing around through the 60s, the 70s, the 80s, 90s. We had a little bit of an uptick in that. And then, of course, we had the top of the housing bubble in 2006, recovery in 2010, and it's all been downhill from there until we get to Q4 2020, where we're hovering right around the 1.13 mark. And in effect, what he's calling dead money. So, What do we make of this stunning expansion of money and equally stunning collapse of money velocity? Ours is a dead money economy. New money is created in the trillions of dollars, but it is either shipped overseas to exporters selling goods to Americans, or it's being stashed somewhere rather than being exchanged for domestically produced goods and services. In other words, our financial system is pushing on a string. It keeps creating trillions in new money, which is either stashed away or sent overseas, having been spent on imported goods. This is the acme of a dead money economy. Lastly, let's look at the Fed's broadest measure of money, MZM, which is inexplicably being discontinued, just as the measure it replaced, M3, was discontinued. Do we need to keep moving the goalposts on money stock to mask the abject trajectory of our dead money economy? Here's the Fed's definition of MZM money stock. So MZM, money with zero maturity, is the broadest component and consists of the supply of financial assets redeemable at par on demand. Notes and coins in circulation, travelers' checks, non-bank issuers, demand deposits, other checkable deposits, savings deposits, and all money market funds. The velocity of MZM helps determine how often financial assets are switching hands within the economy. In other words, if we want a summary of America's financial system, we look at the velocity of MZM money. MZM money stock has skyrocketed right along with M2 money stock. No surprise there. The surprise is that the velocity of MZM money topped out in the inflationary peak of 1981 and has been in a free fall since the start of the financialization globalization era began. Not to put too fine a point on it, but this aligns with the secular stagnation of earnings and wages, which began in earnest at the same time, 1981, and the rising dependence on central bank intervention, stimuluses, which has reached the extreme absurdity where the U.S. stock and bond markets and its entire financial system now teeter on the edge of collapse if there is even a slight hint that 1. The Fed won't give more free candy to Wall Street, or 2. The Fed has lost control of the dead money economy it has created. And if you think a dead money economy is a healthy economy, you might want to cut your intake of delusional. So there you have it, the billions of dollars Fred MZM money stock, which is now being discontinued. And of course, you can see where that currently resides as of 2020. Velocity of MZM money stock, again discontinued, pretty much following the same trend as the previous money velocity chart. So nonetheless, I highlight all that to say that all things are not exactly rosy in the oil economy. Obviously, with the advent of the COVID business, as we talked about, you've heard me say this in broadcasts past. We're putting about 160 billion in per month, and of course, where is that going? It's not trickling down. We don't have trickle-down economics like, back in the days of what was promised under the Bush era or things of that nature. No. And of course, with people being laid off, businesses shut down and everything else, do you think people are just going out and spending this stuff willy-nilly? Or are they hidey-holing it underneath their mattresses? I don't know. It's tough to say. But nonetheless, it certainly paints an interesting picture of the economy. Now, that being said, the other article that I'm going to touch upon here is this, Biblical Lean and Mean, an interesting article out of Rabobank talking about whether or not we are going to see biblical increases in food prices. But before I get that, I want to take you on a little bit of a quick journey here. Just some of the interesting articles talking about inflation and perhaps where our food is actually going to go here, and perhaps even dating back a couple years ago. So some interesting articles. Fears of a return of the 1930s Dust Bowl rise as record drought sizzles Southwest. This was just kicked out here on March 10th. If you look at what is going on down in the Southwest from California, Nevada, Utah, Arizona, New Mexico, parts of Colorado, you realize that it's been exceptionally dry, abnormally dry, if you're in the yellow areas here. And if there's any sort of stuff that's being produced there, well, chances are it's going to require a lot of water to make that happen, or it's not going to get done at all. That being said, we go over to another interesting article here, how Michael Berry warns Weimar hyperinflation is coming. So, again, the Fed is going to be printing dollars left and right, and if you think back to World War II, the old Weimar Republic, well, you remember that back in those days, those dollars and that were literally brought around on wheelbarrows in order to buy a loaf of bread. And so, again, here's the chart 11, end of World War I, caused jump in German money velocity and inflation, much the same as what I just got done talking about in the Charles Hugh Smith article. There you see 1918, 1919, the velocity in that pretty well collapsed at that particular point in time. That tracked by Bank of America Global Investment Strategy from back in that day. Then, let's fast forward back to February 22nd. Says food inflation is the best predictor of bond yields. And, of course, at this point, you heard me the other day say that our CPI index, the figures net that were just recently kicked out, were absolutely bogus numbers, and they knew it. They admitted it. But yet the market reacted and then quickly punted on it. Says food inflation in asset markets. Food inflation globally has been remarkably low in recent decades. Food prices compare very favorably to other inflation indicators, such as the gold price. The U.S. provides good long-term food inflation data back to 1913. While the spike in gold prices in the 1970s foreshadowed rising food inflation, so far rising gold prices seen since 2000 have not presaged an increase in food prices. Well, of course, one thing that's left out of this particular article is the fact that the prices and that spot prices and whatnot are manipulated. So we don't have a true read on where our gold and or silver prices should be at this point in time. Now, let's flash back a little bit further. Take us back to, let's say April or so of 2019. 30 inches of snow. Another bomb cyclone detonates over the Midwest, and the NOAA is warning flooding could extend into July. Michael Snyder had that article back on April 10th, 2019. And if you remember right, another article that I'll touch upon here momentarily, if you remember, we had all sorts of flooding throughout the Midwest. A lot of folks weren't able to get crops in until middle part of the year. And then those that actually did manage to get crops in, had very late season harvests. And even then, they were hit with some bad weather on the back end that also limited their ability to take product to dryers and everything else in order to sell. Says we aren't supposed to have a major blizzard in April, less than a month after a bomb cyclone caused apocalyptic flooding in the central part of the country. Another bomb cyclone is hitting the exact same area. One meteorologist has called it a life-threatening storm, and at this moment over 4 million people are under blizzard warnings. South Dakota, Minnesota, Nebraska, and Kansas are going to get absolutely hammered before the storm finally moves east on Friday. Again, this dating back to April of 2019. And of course, think of those states that I just mentioned, South Dakota, Minnesota, Nebraska, and Kansas. What exactly is growing there? Do we get a lot of wheat, winter wheat especially, grains, things of that nature? And I believe personally that we have yet to see the ramifications of that weather system on the food prices and that here some 2 years almost later. And another article from around the same time says hundreds of millions of dollars in crops destroyed by flooding, and farmers are being told there's nothing the U.S. government can do to help. And of course, this is the worst economic disaster for U.S. farmers in modern American history. Our ongoing trade war with China and greatly depressed prices for wheat, corn, and soybeans, and so farmers were storing more crops on their farms than ever before in early 2019. And then the floods came. The water moved so fast that the vast majority of the farmers in the affected areas could not have moved what they had stored even if they wanted to. And the scale of the losses that these farmers have suffered is starting to become clearer. According to UPI, hundreds of millions of dollars in crops that were destroyed by the flooding were not covered by insurance. So, again, that's a little bit of a precursor as to the article I'm about to cover now and where this is headed. So a quick summary out of this, the key feed and food prices have been pulled to 9-month and 7-year highs. We explore the dream of biblical scarcity, its origins and impacts, and draw comparisons with Joseph, the trader and central planner who avoided starvation for ancient Egypt. One point is clear. Global food insecurity falls heaviest on lower income, importing nations who spend a far greater share of their income on food than the richer ones. The Fed would play an iconic role in this process, even as it embraces fighting poverty and inequality alongside inflation. This could exacerbate geopolitical risk, potentially even regarding institutional architecture. So, the first part of this article is going to get to the biblical side of things. If you recall from Old Testament times, says, Then Pharaoh said to Joseph, Behold, in my dream I stood on the bank of the river. Suddenly 7 cows came up out of the river, fine-looking and fat, and they fed in the meadow. Then, behold, 7 other cows came up after them, poor and very ugly and gaunt. Such ugliness as I have never seen in all the land of Egypt. And the gaunt and ugly cows ate up the first 7, the fat cows. When they had eaten them up, no one would have known that they had eaten them, for they were just as ugly as at the beginning. So I awoke. And that was Genesis 41:17 through 21. So that is kind of the basis for this article, that they're going to make the case that even the articles that I just covered, all of these kind of lead to this. So our base commodity call at time of writing, our forecast for 3 of the world's the key agri-commodities, soybeans, corn, and wheat, are as follows. Here we see soy, corn, wheat, and that quarter 1 forecast, 1400, 550, 660, etc., and where they plan to go, March 22 forecast, futures, etc., on the way down. However, we wish to use this report to dream as Joseph dreamed. We want to imagine a hypothetical scenario, which we see a substantial tail risk, where prices rise far higher than this. In doing so, let's turn to Joseph. Says the first big commodity call. In the Bible, Joseph interpreted Pharaoh's dream as meaning great abundance for 7 years would be followed by an equal famine. He was then entrusted with ensuring Egypt's storehouses were full of grain so the country could survive, which he and it did. So in short, Joseph made the first agri-commodity cycle call, where survival came before profits. Today we have seed technology, automated agriculture, and global markets. Yet we still have lean and fat years for reasons meteorological, logistical, political, and geopolitical. This report will try to do several things. 1. Summarize price action in the key agri-commodities to consider if we're seeing anything unusual. We will show we are, reflected in our elevated base price forecasts. 2. Disaggregate and define the main drivers of these price movements. This is while the agri-market is very old, new developments could produce striking new price patterns. 3. Imagine what a biblical scarcity would look like, putting forward simplified assumptions to estimate what each of them in isolation could do to food prices. 4. Look at global food insecurity to ascertain how many countries are suffering already and would do so in the scenario the prices rise higher. And 5. Consider the worrying geopolitical implications. So we'll get into this, break it down. Supplies shaken, not stored. And I'm not going to read the whole thing. I may hit some of the highlights here, as this is about a 14-page or so report in that's kicked out. But again, thinking of what we're seeing play out here today. 160 billion added every single month to the money supply, right? What are we seeing by way of commodity prices today? Whether it be lumber, whether it be copper, whether it be steel. Do you think at the end of the day that we're going to see the same thing happen with wheat and corn and soybeans and everything else? Oh, you betcha. So, for key feed and food commodities, the message for markets and institutions is a simple one. They are going up. The S&P Global Agriculture Index is up for a 9th straight month to its highest level in 7 years, even though we are coming off a low base of comparison, which helps the base effects. The last period to see such a rapid rise was 2011, and prior to that, 2007. When we look at key commodities one by one, the picture is similar, whether it's grains, vegetable oils, dairy, meat, or sugar. This correlation makes sense, especially as many of these products share characteristics, are complementary, or are planted on the same land. And here we see kind of the trend of the various commodities net from 1990 all the way up to and through about 2020, and you can see that each one of these is starting to have an uptick. Says most of the above markets have shifted into strong backwardation, indicating near-term supply scarcity that should ease with harvest replenishment. However, we remain skeptical about the resupply. Rabobank's price forecast for soy, corn, and wheat, the critical building blocks for bread, meat, dairy, biofuels, and more, are in line with the present levels and above the futures curve into 2022. Flashing forward, a bull run of many colors. Today's elevated price trajectory shows nobody had the foresight, fortitude, or financial power to stockpile in the years of plenty. But there are many more factors at play. Rabobank's recent report already covered the key drivers of the agri-bull market. We'll quickly reprise them as follows. Number 1, the exporters' stocks have fallen rapidly to 7-year lows. 2, China is importing on a vast scale. 3, it's hard to increase supply rapidly. 4, adverse weather conditions. 5, countries are engaging in food protectionism. 6, logistical costs are rising, notably in freight. And number 7, speculators are holding more commodities futures. So in terms of the 7 years of plenty, ironically leave global agri-commodity stocks low. Before the recent run-up, the S&P GS Agri-Commodities Market Index had fallen over the last 7 years as a price shock of 2010 to 2012 incentivized diversified supplies and a shift from high-cost to low-cost producers and exporters. This was good news for importers, but bad for the high-cost U.S., who saw its stocks steadily increase through 2019. The U.S.-China trade war and COVID-19 also saw U.S. farmers adjust acreage lower in response. When demand then surged in mid-2020, higher-cost exporters, especially the U.S., sold both their production and stores. In short, the U.S., the Global Food Reserve Bank, has seen its grain and oilseed stockpiles slip nearly 30% year-on-year, primarily in corn and soybeans. Moreover, we forecast only a slight increase in 2021 as our base case. And of course, number 2, China is driving demand. It is aggressively bidding for supplies to fill shortfalls and pad inventories. Convalescence from dual pandemics, African swine fever and COVID-19, has led to a surge in agri-import demand, and hence global prices. The most remarkable increases have been in feed grain, the energy source for animal protein, and ethanol. China's imports of these have risen almost threefold in a year to address a structural supply gap that cannot be addressed by domestic production. Indeed, China is so stretched for feed, it is resorting to using old domestic wheat reserves for livestock, 35 million metric tons this year alone, equivalent to Canada's production in addition to vegetable oil and even pig lard. China's moves are single-handedly testing supply chains to their limits. The saving grace for global markets has been that world demand across many of China's favored imports was absent or squeezed until now. When it returns, global supplies could be stretched further. And here we see the trade winds blow supplies east to voracious China. The blue, dark blue here is the animal protein, the orange is cereals, and the light blue, the soybeans. Number 3, supplies are on a tight rope. Coming months will see a scramble by farmers to plant and harvest, with many products facing scarcity. Competition for limited arable land will limit the potential resupply. The U.S., for example, can only increase its summer plantings by about 5%. Any production on top needs to come from yield improvement. Number 4, everything depends on the weather, where key exporters face an uphill battle. Large swaths of South America are too dry or too wet. Meanwhile, much of the spring planting area in the U.S. faces significant dryness. And of course, that harkens back to the article I just covered, talking about the Southwest especially, where, yes, they are in drought conditions. And that's not to say, too, that we may not see some shenanigans by way of the weather here down through the Midwest. All we have to do is take a look at what just happened with Texas. Whether you want to call it weather manipulation or not, doesn't matter. those things could persist, and who knows what that could do to affect either the spring planting or perhaps even fall harvest. Number 5, there is a heightened risk of protectionist policies. Many critical agri-exporters are already putting up tariffs or export quotas, threatening free trade and curtailing local farm prices and domestic production to keep prices affordable. Rather than fulfilling their critical global role, such exporters are increasingly insulating themselves from global markets. Russia, the world's largest exporter of wheat, has implemented grain export taxes. Ukraine export quotas, and Argentina, the largest exporter of protein feed, has dabbled in export quotas too. Number 6, logistics are tight. If a rising tide lifts all boats, a lack of boats lifts prices. ASF, COVID, and weather events all drive demand shifts that supplies have been unable to anticipate or react to easily. Freight prices have jumped to a record for containers. Bulk, measured by the Baltic Dry Index, has also seen a large increase, and this has delayed and displaced shipments. Naturally, these higher prices fall heavily on importers. Number 7, the speculators. Wall Street funds already hold in-the-money positions in soy and corn, by far their largest net long position. Financial market investors currently hold contracts of grains, oilseeds, and livestock worth almost $50 billion US. Net length, or 35% of the value of all U.S. agricultural exports in 2020. And he says in Figure 5, Joseph Meat Benjamins. A little bit of a play on the old U.S. dollars. What makes this significant, apart from the scale, is that this is happening due to the actions of central banks. While Joseph was second only to Pharaoh, so central banks are second only to governments. Yet they are not helping to smooth out food cycles like Joseph did. Markets have grown used to extreme monetary policy since 2008. However, the aggressiveness of the Fed's current policy stance, now aimed to let the economy run hot, and the shift to massively expansionary U.S. fiscal policy too, has altered market perceptions of future inflation risks. Investors have responded by holding assets as a hedge: stocks, property, and gold, and Bitcoin. Yet, Wall Street is now speculating with agri-commodities too, even though this pushes up inflation. So now, in terms of the biblical rally, well, having then listed the various structural reasons for agri-commodity prices to have risen so fast, we free our minds to dream, if that is the right word, of a biblical price rally. Our bull market stands on 4 legs. 1, normal supply and demand, which is how day-to-day markets are supposed to work. 2, China, given its import appetite, makes it the marginal buyer that matters most. 3, politics, covering changes to trade flows, protectionism, tariffs, and export controls. And 4, Wall Street, where could equally say the Fed. Leg 1, the normal supply and demand. As noted, the FAO price index at 7-year highs is supported by rises in all of its components: sugar, cereals, meats, oils, and dairy. In our dream, we ruminate on the products who have risen the most, and are thus closest to scarcity: cereals and oil seeds. They are currently so tightly balanced, a small weather issue, a regular occurrence in agricultural markets, could tip the scales toward global scarcity. So, if we were to get, say, just like I described of the winter bombshell that we had back in 2019, think of what that would do to tip the scales. The USDA, today's high priests of agriculture, expect maximum acreage and healthy yields in the U.S. to maintain, but not reflate, stocks. Yet they are arguably dreaming. The U.S. has seen 2 consecutive disappointing summer crops: feed grains 359 and 375 million metric tons, soy 93 and 113 million metric tons, and yields can often worsen rather than improve on expanded, less ideal acreage. Imagine a 3rd consecutive lackluster U.S. summer harvest. Even if last year's average, not poor, yields were repeated in corn or soy, supplies would fall below 2012 levels. a time prices were 35% higher than today. All else equal, even a 3 to 4% drop in production could move soy and corn prices up by a third. So, again, thinking to what we buy in stores today, well, do you think that those boxes of cereal are going to get bigger and you're going to pay less? Oh no, they'll do the same thing as they did in 2008 after the economy did its little hoop-de-loo back then. We'll see the boxes get smaller. You'll pay the same price, but you'll be paying for less. In normal times, alternative grain and oilseed export surpluses might help cushion the blow of a U.S. supply shock. But if we take these into account too, cumulative exporter stocks to use are still close to 2012 levels. We start with soy and corn, but feed grains and oilseeds compete for acreage with other commodities. Moreover, soy and corn are the primary feed components for both animal protein and dairy, and produce cooking oil and biofuels. Wheat, for one example, exhibits slow demand growth in line with slowing global population growth, but also little elasticity. The upside is that there are so many substantive exporters, which distributes supply risk. Yet global exporter stocks are again already near 2012 lows. A 10% production cut in major suppliers like the EU, US, or Russia could lift prices 30% to levels last seen in 2012. It says, can this Pharaoh's dream be interpreted to see any one commodity evading inflationary capture? Current futures market positioning may be too somnolent. And of course, this map ought to look pretty familiar because that's what we just covered here by way of the drought, very same map. Figure 7, I said milk and honey, not bitter herbs. And the sources, the NDMC, NOAA, UNL, USDA, colored areas denote the drought report as of March 11th, which I highlighted previously. It says, as noted, adverse weather is already affecting major production areas. Over 90% of the U.S. northern plains, the area most likely to boost overall acreage, 50% of the Midwest, and 59% of the South are already in some form of drought. With winter wheat emerging and soy, corn, and cotton about to be planted, the terrain looks nothing like the promised land the USDA is projecting. Perhaps they shouldn't have slept on the National Oceanographic and Atmospheric Association report predicting 3 months of dry, warm U.S. conditions ahead. And what if we were to get a real U.S. drought, as in ancient Egypt? Obviously, this would be far, far worse on all fronts. So leg 2, politics. How does this factor in? Well, any crisis in food inflation risks being exacerbated by food politics. Emergent food export heavyweights like Argentina, Ukraine, and Russia have played a role in driving prices higher through export taxes and controls, and trade wars have been destabilizing and inefficient for agri-flows. In short, global supply chains appear bereft of the underlying geopolitical stability assured until recently. In the case of a future supply issue, however modest, there is a risk of heavier export controls. For one key hypothetical example, if Russia re-implemented its ban of 10 years ago on even half its export potential, 19 million tons, the ensuing burden on the U.S. and others could double wheat prices to the USD 12 bushel last seen back in 2008. A further political catalyst is biofuels, beneficial for farmers and the environment, but which exacerbate agri-commodity supply stresses by shifting production from food towards renewable energies made from agri-commodities, namely biodiesel and ethanol. Figure 8 below shows higher income nations employing over 12% of their caloric inputs, primarily vegetable oil and feed grains, for biofuel ingredients. It says, let's use the good olive oil for our lamps. The ethanol market was largely absent last year amid a surge in feed demand. Its return could exacerbate supply pressures. For the U.S., a 500 million bushel rise in ethanol usage fully offsets potential acreage expansion in 2021. For example, assuming a doubling of ethanol exports to China, it would not be unrealistic to assume corn prices could potentially rise a further 15%. Full implementation of biodiesel and renewable diesel mandates in Indonesia, Europe, Brazil, and others, supported by high diesel prices, would potentially drive support for key component vegetable oils like palm and soy, near or to record levels. In short, in the short term, where politics happens, the green transition could mean higher food prices. Green New Deal, huh? Another facet of that that's probably not thought of and talked about all that much. Leg 3, China. China is the single biggest swing factor besides weather and production. It has the potential to disrupt global agri balance sheets for years to come. In the past, China has implemented Joseph-like policies and holds large stockpiles of wheat and rice. However, amid elevated domestic prices and imports of dairy, pork, oils, and grains, it is far from apparent that China is purely engaging in strategic restocking. Rather, in our dream, we interpret that China is rapidly destocking its products, or end products, including feed grains and oilseeds. Higher imports and domestic production increases are the apparent solution. China is expected to import 35 to 45 million metric tons of feed grains per year for the coming years, which much more if rosy production expectations are unfulfilled. If China's domestic output disappoints, it would exacerbate a structural deficit requiring yet higher imports of grains and oilseeds by as much as 15 million metric tons, and raise global prices of corn and soy by additional 30%. So Figure 9 highlights China's Great Wall of GNO made in the USA. So Leg 4, Wall Street. Well, as already noted, Wall Street is an established player in the agri-commodity space and has room to grow its inflation, hedging bets from here. Despite current long positions, the overall net position is still nearly 10% below the record. Wall Street probably wouldn't increase its positions in a vacuum, but if any of the above legs come to pass, it would likely respond. Funds could easily extend their speculative length, not just in feed, but also wheat. This dream could help push agri prices up to the 2012 peak, 40% higher from here. Moreover, should U.S. ultra-loose monetary and fiscal policy produce significant U.S. inflation, or stagflation, and or yield curve control to peg the long-term cost of borrowing, Wall Street could again likely increase its agri-commodity inflation hedges. And we summarize the relative impact on soy, corn, and wheat in this bad dream scenario below. The table shows this is how many cows we could have, man. And of course, referencing the 7 fat cows versus the 7 gaunt cows in the biblical reference here. We see weather, politics, China, Wall Street. In the columns, we see soy, corn, and wheat in the rows in that here and how those stack up. It says, for soy, the primary price driver ahead is weather, 5 from a maximum 7. Then China and Wall Street equally, 3. Then potential political action, 2. For corn, China is the largest potential factor with 5, followed by weather, 4. Then Wall Street, 3, and politics, 2. For wheat, weather, 3, politics, 3, and China, 3 are all equally important, with Wall Street relatively less so, with 2. Of course, all cows stand on 4 legs, and any one of the factors above could play out individually for any one commodity to significant effect. Yet, as with any cow, where one leg goes, the others usually follow. In short, if we were to see bad weather and protectionism/sustainability-related regulations and further heavy buying from China and a surge in Wall Street speculation, then it is hard to say just how high prices could reach before demand destruction kicks in. So then we get to food security. The impact on food security should be obvious. Indeed, it already is. In the MENA countries, the highest per capita consumers of bread, the 30% increase in international wheat prices seen so far in 2021 leaves them just shy of levels seen during the Revolutionary Arab Spring. Asia's burgeoning middle class is grappling with 30 to 50% increases in pork, cooking oil, sugar, and dairy prices, and Africa, with lower GDP per capita, has an even clearer predicament. Yet, in our dream, things get worse. The impact of price increases will fall disproportionately on poor, importing countries, reversing the improved economic outlook for some of the new global middle class. And even lower income deciles in the wealthiest countries would feel it. We attempted to summarize these risks with simple snapshots. World Bank data from 2017 show U.S. dollar income per capita around the world at purchasing power parity. The same data also show the amount spent on food per capita. One can then calculate the percentage of income allocated to food. Obviously, the figures vary between wealthy regions, such as North America, and poorer ones, like Africa, where the differential is over a factor of 4. And here we see that. 4 legs and 4 times. East Asia, Pacific here to the left, Europe, Latin America, the MENA countries, North America, South Asia, and Africa. And then 2017 figures. Holding some figures constant, as this is just an indicative exercise, we then can change agri-commodity inflation. Although such agri-price changes have and will vary by commodity, we use the aggregate index as a base to avoid having to break down the complexities of varying national diet patterns. As we showed, since 2017, agri-commodity inflation has been substantial, 45%. We then project a hypothetical doubling of the agri-commodity basket for our lean cows dream on top. We must then consider how much of the change in price in the agri-commodity basket is actually passed on to higher food prices. One might be surprised how little of the cost of the foods we eat actually reflects the raw ingredients as opposed to labor, rent, logistics, etc. Keeping all of these factors unchanged, we presume that agri-commodity inflation of around 100% would translate into recorded global, I'm assuming they meant record, global food price inflation of around 12%. This reflects OECD food inflation of 6 to 8% in recent scarcity events, while recognizing that in some sectors and markets this has tended to be higher, in particular for import-dependent countries. As can be seen in Figure 12, on a regional basis, we can see that for East Asia and the Pacific, the percentage of individual income spent on food rises from 9.3 to 10.4%, and in Europe and Central Asia from 8.6 to 9.6%, Latin America 11.5 to 12.9%, Middle East, etc., etc. Says, of course, the actual impact may be less given incomes would have risen in most places in the past 4 years in line with GDP growth. But then again, COVID-19 could well have seen these gains partially reversed in many locations. And here we see deja vu, echoes of food inflation past, looking from 1991 forward all the way through 2021. To put this into perspective, one also needs to consider where a crisis threshold lies in terms of food affordability. Although this again varies for a number of reasons, if one selects the 20% of income as the key level, double the world average, then the global impact of this dream agri-commodity price shift cannot be understated. And here we see the creaking food basket, again looking at East Asia, Europe, Latin America, MENA countries, all the way over to Africa. The blue represented in the 2017 figures, and the lean cows is in the biblical example, obviously higher in all cases. Says Figure 13 shows the number of countries in each region that were already at risk of food insecurity using the World Bank's 2017 data, compared to the number projected ahead using our lean cows assumption. As can be seen, Central Asia sees one additional country slip into food scarcity. Latin America, 1, MENA, 1, and South Africa, 2. Again, this is presuming a 12% increase in food prices. If more lean cows were to emerge, more people would also get leaner. And here again, now we see the lean cows versus 2017 figures for the same thing. It says we should feel insecure about such food insecurity. It says, even as is, 42 countries globally would be food insecure, and a staggering 102 countries would see a relative decline in their purchasing power of food, representing a step backwards down the pyramid. Maslow's pyramid of basic needs. We would be back below 2011 levels in terms of food affordability, representing over a lost decade in the fight against hunger. At the very least, steady progress experienced by much of the emerging world's middle class could be frozen or reversed. That's a process we have seen end in populism in Western economies already. So, Yom Kippur, a little bit of a play on words here. Well, we are talking here about a potential surge in parts of the agri-commodity complex. However, our global macro inflation thesis remains very different. We continue to recognize the significant near-term upwards price pressures in many areas of the economy, which stem from a combination of base effects, COVID-related supply disruptions, genuine demand increases, or shifts, and looming U.S. fiscal stimulus. Yet, as we have argued for many years, structurally, one only sees inflation sustained if either supply is too weak, and outside agri-commodities and semiconductors, this is not an issue, or demand too strong, and workers still do not have the bargaining power to push for pay raises in most sectors of most economies. The present U.S. fiscal stimulus does not address this issue at all. Indeed, the greater likelihood is still that after an upward surge in H1 2021, there will be a downshift in aggregate inflation pressures again into 2022. Were we to see a bounce in the U.S. dollar on the back of the higher long-end U.S. rates, this would exacerbate that trend. It could also partially weigh against some of the bullish agri-commodity trends we consider. Moreover, were we to see an economic slump after the current U.S. fiscal sugar rush, then presumably agri-commodity prices would come under further downward pressure. Note that previous spikes have often been rapidly followed by such a slump, more like 7 lean than 7 fat months in that case. In that case, the Wall Street speculation we have already underlined would also be rapidly reversed, and what has helped make for fat markets would then be make for lean ones. In short, volatility would be amplified in both directions. Nonetheless, let's dream agri-commodity prices stay high for structural/political factors, even as aggregate inflation falls back due to a weak global economy. We have seen something similar to this hypothetical backdrop previously if one shifts the kind of oil one is thinking of. Indeed, think of the oil price spike experienced after the Yom Kippur War of 1973. And Arab oil producers responding with reduced supply into what was then a far more Keynesian, fiscally driven world economy. WTI oil, for example, jumped from US dollar $3.56 in July 1973 to US dollar $4.31 at the end of that year, a 21% increase, and then again to US dollar $10.11, a 293% increase from the July 1973 price at the start of 1974. In response to Arab oil states' actions. This necessarily pushed general inflation much higher in tandem globally. And here we see oil was not well that ended well. Looking from January 1970, past January or so of 1978 and how that increased. It says, as we know, the demand-led policies of Western economies, which were still far more regulated, far less globalized, and had far stronger unions at that time, led to inflation matching pay raises, so setting off a wage price spiral. Consequently, oil prices marched as high as US dollar $39.50, a 390% increase over January 1974 and a 1109% increase over July 1973, before eventually declining. What is critical to recall is that this episode was arguably the key political driver of the structural reforms put in place to globalize and liberalize Western economies in order to reduce the power of labor in favor of capital, capping inflation pressures in the process. With global populism rising and critics pointing out those reforms have gone too far, producing socioeconomic problems of an entirely different but just as damaging kind. The key hypothetical to ponder is this. Could a sustained rise in agri-commodity prices prompt a political backlash away from the neoliberalism and back towards deglobalization and regulation? Could the Yom Kippur-driven reforms be reversed by a Yom Kippur? Interesting. Of course, nobody knows. However, you don't have to be Joseph to see that political development such as Brexit and obvious examples of agri-protectionism mean it would be dangerously naive to rule this risk out entirely. This in itself would then open up a new discussion of what such a structural shift might mean for the increasingly turbulent geopolitical backdrop and how that then might flow back to markets. After all, there was open talk of an Arab oil weapon after the 1970s, and the emergence of the petrodollar was intimately linked to how the huge oil surpluses Arab states then began to accumulate were recycled, in short, into the U.S., in exchange for U.S. military protection. This brings us firmly to geopolitics. And Pharaoh said to Joseph, "See, I have set you over all the land of Egypt." Not just any dream will do. After all, let's not forget that Egypt was the ancient world superpower because of its grain harvest. The flow-through from food prices to geopolitics today should be obvious. First, weaker states could find themselves at risk of significant instability. It's not a coincidence the last global agri-commodity price surge coincided with the Arab Spring. Given even developed economies have experienced major socio-political unrest, the risks should be self-evident. In short, an agri-commodity price spike, like COVID-19, could be an accelerant to pre-existing political trends. Second, we live in a new age of great power politics, centered around an unfolding U.S.-China rivalry, in which U.S. food production and a Chinese food deficit plays no small part. Would higher agri prices mean the U.S.-China Phase 1 trade deals hold or breaks? For example, more broadly, a key question is whether an agri-commodity price shift higher would help force changes in the structure of the global economy and financial system. We have covered the likelihood of a paradigm shift away from the U.S. dollar many times, and have always been highly skeptical. Yet hunger is a powerful incentive for action. Such a lean backdrop could accelerate efforts to shift the global trading system away from the U.S. dollar. Both China and Europe could push for adoption of alternative payment systems, or, at the very least, for commodity pricing in euros or Chinese. China is already trying to boost local agri-production and diversify its agri-imports. However, it would require an entire network of major agri-producing countries to make a FX trading paradigm shift away from the U.S. dollar in tandem with its order to break free from the U.S. dollar yoke in agri-markets. Until then, China would remain in a relatively weaker position vis-a-vis the U.S. on this key front. Its huge appetite for agri-commodities, and by extension U.S. dollars, would remain, and if it were to continue to snap up global agri-supplies, then resentment could rise against it too, along with said prices. On one hand, this suggests a weaker Chinese yen, as we saw under previous periods of structural stress, over exports to the U.S. and technology controls. On the other hand, a stronger Chinese currency would help make agri-imports cheaper. In short, China would have difficult strategic choices to make, with each option coming with major trade-offs. Europe would be better placed in terms of food security, due to its comfortable agri-surplus and high incomes. It also has plans to broaden the international usage of the euro, yet its twin Achilles heels are still that relies on a U.S.-controlled euro-dollar and a U.S.-owned defense umbrella. Emergent global middle powers would have to adapt to a multipolar, volatile geopolitical environment and ponder what food insecurity means for their own strategic positioning. For exporters and importers, it obviously implies very different opportunities/risks. More concretely, would they side with the U.S. or China if forced to make a choice in the global trade currency exchange paradigm? Meanwhile, there would likely be a new race for Africa. China has been extremely active there in recent years, so has Russia and Turkey, and the EU sees itself as having a major role in both Africa and the Middle East. America is also likely to be involved, albeit under the guise of national security, which, in a way, it of course is. Unfortunately, however, just as the gold-pegged US dollar segued to a new, bigger fiat role as the petrodollar, backed by US military might, so the stronger global eurodollar would be supported by the US being a major net food producer, an exporter, and military power. Indeed, global food insecurity would underline the extent to which the U.S. can ride out food price cycles that batter other economies, supporting its hegemon status. For countries unable to afford food import priced in U.S. dollars, the U.S. would be in the position to bail them out with FX swaps or loans as it saw geopolitically advantageous, or to support multilateral organizations doing the same. It might not be able to produce extra food at short notice, but it could produce U.S. dollars to buy existing food, even if it forced prices to spiral even higher in the process. Yet at the same time, however, global resentment of the U.S. dollar or U.S. would likely rise if these actions did not materialize, and/or on the perception that the old adage of the dollar is our money and your problem were the U.S. starting point. How much global patience would there be for the Fed and U.S. government to echo Dr. Martin Luther King Jr.'s I Have a Dream on equality if the global outcome was greater food insecurity? How does one sell helping the poorest in one of the world's richest economies if it also hurts the poor in the world's poorest economies? In short, it is the stuff of bad dreams, but high global food prices would deepen and widen pre-existing geopolitical fault lines and open up new ones. This could easily flow back to agri-commodity markets in a reflexive process. So what dreams may come? Well, although nobody's dreams correctly tell the future, there appears a worrying risk that many individual factors, weather, politics, China, and Wall Street, could individually, and in a worst case, collectively, push up global agri-commodity prices significantly on top of the marked increase that we have already seen in 2021 to date. Were this to prove the case, food insecurity would obviously increase, with the impact potentially felt by billions, most so in sub-Saharan Africa and South Asia. We would face a potential lost decade for reducing food insecurity and improvements in disposable income, and the rapid growth of their middle classes could be stunted for years. In terms of food affordability, 42 countries would be worryingly insecure, and 102 would be worse off than they were in 2011. Critically, this would not be something the current global political economy would passively accept. Shortages of luxuries or electronics are one thing. Food is quite another. Rising populism among a weakened middle class in the West, 2020's scramble for PPE, and 2021's dash for vaccines already all show just how easily the rules of the global trading order can be upended when local politics dictates. All of this would only exacerbate geopolitical tensions that are already evident across various locations. Moreover, it could, in some scenarios, such as last seen in the 1970s, shift our global political economy and financial architecture in new, or rather old, directions. At least it may see attempts at such, even if not successful. Food for thought, Joseph, as we consider how Pharaoh this rally still has to run. So, kind of an interesting article to think about here in terms of global food security, or lack thereof, where things are headed. A couple things to note of that perhaps maybe they didn't take into consideration is the Great Reset, the agenda there, where that may go. Obviously, what is that going to do to food prices? What is that going to the up-and-coming economies, whether it be the 40 or 102 countries not cited here? What does that do to them? And then the other thing I would wonder a little bit about is all the land that people like somebody like Bill Gates has bought up here, and the thousands and thousands of acres here stateside. What exactly is planned for that? And then also consider the push for the fake foods. We already have the fake meats and things of that nature. And of course, if you think back to what the Davos crowd, the World Economic Forum, the Klaus Schwabs and company are pushing for, well, you little peons, you what once were middle class folks, now pushed down into the poverty folks, well, you guys just eat bugs while the rest of us eat steak. So, a lot of things to consider. Obviously, I thought I'd bring it to your attention. Again, food for thought. And I thought that, using the comparison to Joseph in the days of Egypt, talking about the 7 fat cows versus the 7 lean, the gaunt cows, where and how does this play out over the ensuing months? My advice, obviously, as always, is to do your own preparations, grow your own stuff, prepare accordingly. We could be in for some very turbulent times, obviously, as evidenced in what is laid out here. Again, dating back a couple years ago with what we saw through the middle part of the country with crops late to get in. Who knows what the heck they're going to do with our weather systems. The days are upon us where we see more and more the chemtrails in the skies shifting via HARP, whatever is going on there. We're going to have to be prepared for all things at this point, so it would behoove us to have our own seeds, have our own growing mechanisms, have multiple ways to grow things at that rate, and just be prepared in general. Have rations on hand. Are we going to have enough to get through 7 years worth? Well, I don't know. Maybe not, but we can certainly bargain with our neighbors and everything else. So that's where I'll leave it here for tonight. Appreciate you guys tuning in as always, and we will see you back on the next one. Take care, everybody.